Before we begin, it's crucial to understand that this presentation is for educational and informational purposes only. I am not a licensed financial advisor, loan officer, or attorney. The process of financing and building a home is a significant financial undertaking with many variables specific to your situation, location, and the current market. You should always consult with qualified, licensed professionals, including lenders, builders, financial planners, and legal counsel, before making any decisions or commitments. Imagine this for a second. You've done it. After years of scrolling Zillow, after countless weekends driving through neighborhoods, you found the perfect piece of land. It's got the old oak tree you wanted. It's in the right school district. It's where you can finally see your future taking root. You've got a folder thick with floor plans, a Pinterest board overflowing with kitchen ideas, and a heart full of excitement. You walk into your local bank, confident, ready to make this dream a reality. You sit down with the loan officer, you lay out your vision, and you ask for a mortgage to build your dream home. And the banker smiles politely, because you can't get a normal mortgage for a patch of dirt and a stack of blueprints. What you're asking for isn't a loan for a house. It's a loan for an idea, promise, a construction project. And for that, you need a completely different financial tool. A tool that is far more complex, far more involved, and frankly, far more intimidating than a standard mortgage. It's a tool that can either be the engine that builds your dream, or the anchor that sinks it before the foundation is even poured. This is the world of the construction loan, and mastering it is the single most important financial skill you will need to build a new home in the United States. Forgetting to account for this process is the #1 reason why custom home builds go over budget, get delayed for months, or in the worst cases, fail completely, leaving families with a half-finished money pit and a mountain of debt. But that is not going to be you, because over the next 10 parts of this series, we are going to pull back the curtain on the entire construction loan process from A to Z. You will learn exactly how it works, what banks are looking for, how your builder gets paid, and how to navigate the system to protect yourself and your investment. This isn't just theory from a textbook. This is the practical, step-by-step playbook that will give you the confidence to walk into that bank, not with hopeful excitement, but with a rock-solid plan. So, what makes a construction loan so fundamentally different from the 30-year fixed-rate mortgage everyone talks about? It all comes down to one word: risk. When you buy an existing house, the bank's risk is relatively low. They can send an appraiser out, see the finished product, and verify its value. The house is a tangible asset. It exists. If worst-case scenario you stop making payments, the bank knows exactly what it can take back and sell to recoup its money. It's a clean, straightforward transaction. But with a construction loan, the bank is lending you hundreds of thousands, or even millions of dollars for something that doesn't exist yet. They are placing a massive bet on you, your builder, and your plan. They're giving you money for a foundation that hasn't been poured, for walls that haven't been framed, and for a roof that's still just a line on a drawing. Their collateral isn't a house. It's a project. And projects are loaded with risk. What if the builder is incompetent? What if the cost of lumber skyrockets halfway through the build? What if you, the borrower, run out of money before the kitchen cabinets are even installed? To protect themselves from this massive risk, the bank doesn't just hand you a big bag of cash and say, "Good luck." That would be financial suicide. Instead, they structure the loan in a way that gives them maximum control and oversight throughout the entire building process. They become your financial partner whether you like it or not. And the core mechanism they use to control the money is something called a draw schedule. This is a term you absolutely must understand. The draw schedule is the heartbeat of your construction loan. Think of it like this. A regular mortgage is like a fire hose. The bank turns it on once, fills your bucket with all the money for the house, and then you're responsible for paying it back over time. A construction loan, on the other hand, is like a carefully controlled for drip. The bank doesn't release all the funds at once. Instead, they release the money in stages, or draws, as specific construction milestones are completed and verified. For example, the first draw might be for clearing the land and pouring the foundation. Your builder does the work, and once it's done, you request a draw from the bank. The bank then sends an inspector to the property to physically confirm that the foundation is, in fact, complete and built to spec. Only after that inspection passes does the bank release the money to pay the builder for that specific phase of work. Then comes the next milestone: framing the house. The builder completes the framing, the inspector comes out again, verifies the work, and the bank releases the next draw. This process repeats over and over again for the roof, for the plumbing and electrical, for the drywall, all the way until the final coat of paint is on the walls and the certificate of occupancy is issued. This draw schedule system is the bank's primary tool for managing risk. It ensures that their money is only being spent on actual tangible progress. It prevents a shady builder from taking a huge chunk of cash up front and disappearing. It confirms that the value of the collateral, the partially built house, is increasing in step with the amount of money the bank is lending out. So, at its core, the entire construction loan qualification and management process is designed to answer two fundamental questions for the lender. Every piece of paperwork you fill out, every blueprint you submit, every meeting you have, is all about satisfying these two concerns. Question number 1. Can you and your team successfully manage this project and see it through to completion? The bank is vetting you, but they are also vetting your builder, your architect, and your plans. They need to believe that your team has the experience, the financial stability, and the detailed roadmap to actually finish the house. They're not just looking at your credit score, they're looking at your builder's resume and balance sheet. Question number 2. When the project is finished, will the house be worth enough to cover the loan? This is where the appraisal comes in, but it's a special kind of appraisal. It's an as-completed appraisal, where an appraiser looks at your land, your detailed building plans, and the list of materials and finishes, and estimates what the value of the house will be once it's built. The amount the bank is willing to lend you will be based on that future hypothetical value. If your dream home plan is going to cost $1 million to build, but the appraiser determines it will only be worth $800,000 in that neighborhood, you have a massive problem. Understanding these two core anxieties of the lender is the key to unlocking the entire process. Everything you do should be aimed at proving you have a solid plan and a competent team, and that the final product will be a sound investment. In the parts to come, we will break down exactly how you do that. We'll explore the two main types of construction loans, the one-time close and the two-time close, and the critical pros and cons of each. We'll walk through the rigorous documentation you'll need to assemble, from architectural plans to a detailed budget that will be scrutinized line by line. We will talk about how to choose a builder that the bank will actually approve of, and the common red flags that get applications denied instantly. This journey is complex, but it is not impossible. Getting this right is the difference between standing on your new front porch with a set of keys in your hand and staring at a half-finished frame rotting in the rain. So let's get it right. Let's start by looking at the very first decision you'll have to make. And that first decision isn't about paint colors or kitchen cabinets. It's about the very structure of your financing, and it boils down to this: are you getting one loan or two? This choice forks your entire journey into two distinct paths, and most people don't even realize they're making it until it's too late. Let's call these the one-time close and the two-time close. Understanding the profound difference between them is your first major win. First, the one-time close, also known as a construction to permanent loan. Think of this as the all-in-one streamlined Swiss Army knife of building a home. You go through the underwriting process once. You sit at a closing table once. You pay one set of closing costs. From that moment on, you have a single loan that seamlessly transitions from the construction phase into your final long-term mortgage. During the construction phase, which might last anywhere from 9 to 18 months, you typically only pay interest on the money that has actually been paid out to your builder. So as the house gets built, your monthly payments slowly ramp up. When the house is finished and you get your certificate of occupancy, the loan automatically flips a switch. It converts into a standard principal and interest mortgage, just like the one your friend who bought an existing house has. You don't have to reapply, you don't have to requalify, you don't have to face the terror of a second appraisal. The interest rate for your final mortgage? You locked that in months ago, before the first shovel ever hit the dirt. It provides peace of mind. It's predictable. Now let's look at the other path. The two-time close. This is actually two separate loans. The first is a short-term, construction-only loan. Its sole purpose is to fund the building of your house. It's an interest-only loan, and when construction is done, the loan is due in full. Poof! To pay it off, you then have to go out and get a second loan, your permanent long-term mortgage. This means you go through the entire underwriting and approval process twice. You pay two sets of closing costs. You face two different lenders, two different appraisals, and two different moments of truth. So why on earth would anyone choose the two-time close? Well, there can be advantages. Sometimes the interest rates on the initial construction phase are slightly lower. More importantly, it offers a certain kind of flexibility. If interest rates have dropped significantly while your house was being built, you have the opportunity to secure that new, lower rate for your final mortgage. You're not locked into the rate from a year ago. It also gives you the freedom to shop around for the best mortgage deal on the open market, Once your home is a finished, tangible asset. But with that flexibility comes massive risk. And this is where so many dream projects turn into nightmares. Imagine this: you get approved for your construction loan. Your builder starts working. For the next 12 months, life happens. Maybe you change jobs. Maybe your spouse decides to stay home with the kids, changing your household income. Maybe you had an unexpected medical bill that dinged your credit score. Or, and this is the big one, maybe the overall economy shifted and interest rates have skyrocketed. Now your house is built. It's beautiful. But that first loan is due and you have to go qualify for the second one. The bank looks at your file again and everything has changed. Your income is lower. Your credit is bruised. The interest rates that were 3% when you started are now 7%. Suddenly, the monthly payment you plan for has doubled. You might not even qualify for a loan large enough to pay off the builder. This is not a hypothetical. This exact scenario has financially ruined people. You've successfully built a house you can no longer afford to live in. So the one-time close offers security. The two-time close offers a gamble on a better future outcome. For most people, especially first-time home builders, the security of the one-time close is worth its weight in gold. Now, whichever path you choose, the mechanics of how the money actually gets from the bank to your builder are the same. And this is the most misunderstood part of the entire process. The bank does not just write your builder a check for $500,000 and say, "Good luck, see you in a year." That would be insane. Instead, the money is paid out in stages based on completed work. This is called a draw schedule. Before your loan is even approved, you, your builder, and the bank will agree on a detailed draw schedule. It's a roadmap that ties payments to specific construction milestones. Think of it like this. The bank is your partner, but a very cautious one. They're not paying for promises, they're paying for proof. Here's a simplified example of what a draw schedule might look like. The first draw might be released after the land is cleared, the foundation is poured, and the initial inspections are passed. The builder can't get that first chunk of money, say 15% of the loan, until an inspector hired by the bank goes out to the site, takes pictures and confirms, yes, the foundation is complete and up to code. Once the builder receives that first draw, they use it to pay their subcontractors, buy materials, and start the next phase, framing. They'll get the house framed, put on the sheathing and the roof. Boom! Milestone 2 is complete. The inspector comes out again, verifies the work. The bank releases the second draw, maybe another 20%. This process repeats itself over and over. A draw for rough-in plumbing and electrical. A draw for insulation and drywall. A draw for installing cabinets and flooring. A draw for final paint and fixtures. Each step requires verification before the next check is cut. This system protects everyone. It protects you, the borrower, because it ensures your house is actually being built according to plan. It prevents a shady builder from taking a huge chunk of money and disappearing. And it protects the bank because they know their investment, their collateral, is increasing in value at every stage. They're not lending on an empty piece of dirt. They're lending against a home that is demonstrably and verifiably coming to life. But what happens when things go wrong? Because they always do. This isn't a perfect, clean process. This is construction. Let's say the excavator is digging your foundation and hits a massive, unforeseen granite ledge that wasn't on the geological survey. Blasting it or hammering it out is going to cost an extra $20,000 that wasn't in the budget. Where does that money come from? It doesn't come from the draw schedule. The bank isn't going to just increase your loan amount. This is where the single most important safety net in a construction loan comes in. The contingency fund. A contingency fund is a percentage of your total construction cost, usually between 5% and 15%, that the bank requires you to have set aside, in cash, before they'll even approve the loan. This is your oh crap fund. It's for the unknown unknowns. It's for the granite ledge, the sudden spike in lumber prices, the custom windows that arrive in the wrong size and need to be reordered. The bank forces you to have this because they know that a project without a contingency fund is a project that's one bad day away from failure. If you hit that granite and don't have the $20,000 to solve it, construction grinds to a halt. The builder can't move forward. They can't hit the next milestone to trigger the next draw. The project dies on the vine, and the bank is left with a loan on a concrete hole in the ground. Your contingency fund is the financial grease that keeps the wheels turning when friction inevitably occurs. It's not optional. It's the difference between a delay and a disaster. So you've picked your path, the one-time or two-time close. You understand the draw schedule, the flow of money from the bank to the builder based on progress. And you know you need a hefty contingency fund ready for the curveballs. You have the blueprint for the financial process. But now we have to talk about the most personal part of this journey. What does the bank see when they look at your finances, your credit, your job history? Because getting approved for a construction loan isn't like getting a mortgage for a house that already exists. The bank is taking a much bigger risk. They're not just betting on a piece of property, they're betting on a blueprint, a builder, and most importantly, on you to see it all the way through. And their standards for who they're willing to bet on are in a completely different league. So what does being in a different league actually mean when you walk into a bank asking for a construction loan? It means the lender is about to put your financial life under a microscope. This isn't just a quick check of your credit score and a glance at your pay stubs. This is a deep forensic audit of your financial stability. They are looking for one thing above all else: proof that you can withstand pressure. Because building a house is the definition of financial pressure. There will be delays. There will be overages. Things will go wrong. And the bank needs to know with near absolute certainty that when the pressure mounts, you won't be the one to crack. To figure that out, they focus on 3 core pillars of your financial identity. Think of these as the 3 great trials you must pass. Get any one of them wrong, and the gates to your dream home remain firmly shut. These are your credit score, your debt-to-income ratio, and your down payment. Let's start with the credit score. With a standard mortgage for an existing home, you might hear about programs that accept scores in the low 600s. For a construction loan? Forget it. For most lenders, the absolute hard floor, non-negotiable minimum is a 680. And let's be crystal clear. 680 is the score that gets your foot in the door, but it doesn't get you a seat at the table. To be taken seriously, to get the best terms, and to signal to the lender that you are a prime candidate, you need to be north of 720, and ideally 740 or higher. Why the obsession with this 3-digit number? Because a credit score isn't just a number. It's a story. It tells the lender how you've behaved with debt in the past. A 740 score doesn't just say you pay your bills. It says you've successfully managed multiple lines of credit over a long period. You've handled significant debt obligations like car loans or previous mortgages, and you've done it consistently without stumbling. It tells the bank that when you borrowed money before, you paid it back on time every time. When a lender is considering giving you hundreds of thousands of dollars for a pile of lumber and a set of blueprints, that history is everything. They're making a prediction about your future behavior based on your past performance. A high credit score is the single best indicator that you are a reliable, responsible partner for what is going to be a long and potentially stressful financial relationship. A lower score, even if it's just okay, introduces an element of doubt. It's a risk they simply don't need to take when there are other applicants with pristine credit histories waiting in line. Next up is the second pillar, and it's arguably the one that trips up most people: your debt-to-income ratio, or DTI. It's a simple concept with massive implications. Your DTI is the percentage of your gross monthly income. That's your income before taxes. That goes toward paying your monthly debt obligations. Lenders look at 2 types of DTI. The front-end ratio is just your future housing payment, principal, interest, taxes, and insurance, divided by your gross monthly income. The back-end ratio is what they really care about. It includes your future housing payment plus all your other monthly debts. Car payments, student loans, credit card minimums, personal loans, everything. For a standard mortgage, you might get approved with a back-end DTI as high as 45%, or in some cases even 50%. With a construction loan, that number gets squeezed. Most lenders draw a hard line at 43%, and many of the more conservative ones won't even look at an application with a DTI over 40%. Let's put that in real numbers. Say you and your partner have a combined gross income of $10,000 a month. A 43% DTI limit means your total monthly debt payments, including your new house, cannot exceed $4,300. So, if you have a $500 car payment and $300 in student loans, that's $800 right there. That leaves you with just $3,500 for your entire monthly mortgage payment. That number has to cover not just the loan itself, but property taxes and homeowners insurance, which can be significant. The reason lenders are so militant about this is, once again, risk. They know that building a house means you'll be carrying 2 housing payments for a while: your current rent or mortgage, plus the interest-only payments on the construction loan. They also know that life doesn't stop just because you're building. Cars break down, medical emergencies happen. If your budget is stretched to a 45% or 50% DTI before any of that happens, your financial life has zero margin for error. A single unexpected expense could be the domino that topples your entire financial house, and the bank will not risk being part of that collapse. They need to see a comfortable buffer in your budget. They need to know that you can absorb the shocks without defaulting. A low DTI is the only way to prove that. And that brings us to the third and final pillar, the one that represents the ultimate commitment, the down payment. This is where the world of construction loans diverges most sharply from regular home buying. We've all seen the ads for 3% down, 5% down, even 0% down for certain government-backed loans. For a construction loan, you need to take those numbers and throw them out the window. The industry standard, the starting point for negotiation, is 20% down. And very often it's 25%. This isn't 20% of the land value. It's 20% of the total project cost. The cost of the land plus the total cost to build the house. So if you're building a $500,000 home on a $100,000 lot, your total project cost is $600,000. A 20% down payment on that is $120,000. In cash. The reason for this massive upfront investment is simple. The bank needs you to have serious skin in the game. From their perspective, if you've only put 3% down, and the project hits a major snag, maybe the cost of lumber skyrockets or your builder runs into unforeseen foundation issues, it's relatively easy for you to walk away. You cut your small loss, and the bank is left with a half-finished house and a massive financial mess. But if you've invested $120,000 of your own hard-earned money, you're not going anywhere. You are financially and emotionally anchored to that project. You will move heaven and earth to see it through to completion because you have just as much, if not more, to lose than the bank does. That massive down payment transforms you from a simple borrower into a committed partner. Now, there is a hugely important exception here that can be a game changer: land equity. If you already own the land you're planning to build on, the bank will often consider the equity in your land as part of your down payment. For example, if you own your $100,000 lot free and clear, that $100,000 can be used to satisfy a huge chunk of your required $120,000 down payment. In this scenario, you'd only need to bring an additional $20,000 in cash to the table. This is why buying the land first is such a powerful strategy for many aspiring home builders. But the cash requirement doesn't stop at the down payment. Lenders will also demand to see significant cash reserves. These are liquid funds, money in your checking, savings, or brokerage accounts, that are left over after you've paid your down payment and closing costs. They want to see that you have a safety net. A common requirement is to have enough cash reserves to cover at least 6 months of payments on the new mortgage. This is your emergency fund, and it proves to the bank that if you were to lose your job mid-construction, you wouldn't immediately default on the loan. So a stellar credit score, a low debt-to-income ratio, and a massive down payment backed by cash reserves. This is the trinity of personal financial qualification. You have to be an A+ student in all 3 subjects. Being great at 2 and mediocre at 1 usually isn't enough. You are being asked to prove on paper that you are in the top tier of financial responsibility. But here's the crucial thing to understand. Even if you are the perfect applicant, even if your credit score is 800, your DTI is 25%, and you're putting 50% down in cash, none of it matters if the project itself doesn't pass the bank's scrutiny. Because you aren't the only one being vetted. The bank is also putting your builder, your blueprints, and your budget through the exact same rigorous stress test. And that is a whole other set of trials that can sink your dream before a single shovel ever hits the dirt. Think of the bank not as a lender, but as a reluctant business partner. They're about to invest hundreds of thousands, maybe millions of dollars into a pile of dirt and a stack of paper. You are the CEO of this project, but the builder is the general contractor, the boots on the ground, the one person who can turn that investment into a tangible, valuable asset, or a half-finished money pit. The bank's worst nightmare isn't you losing your job. It's them having to foreclose on a house that's just a foundation and some framing, exposed to the elements, practically worthless and impossible to sell. So, how do they protect themselves from that nightmare? They start by putting your builder through an approval process that makes your own financial colonoscopy look like a walk in the park. This isn't just a friendly handshake and a glance at their website. This is a deep, invasive background check. First, the bank will demand a complete builder's packet. This is non-negotiable. Inside this packet, they expect to see a copy of the builder's state license, proof of general liability insurance, and workers' compensation insurance. These are the absolute table stakes. If a builder can't produce these immediately, that's not just a red flag. It's a giant, flashing, screaming siren. It means they're either disorganized or, worse, operating illegally. The bank will walk away instantly. But that's just the opening act. The real vetting is in the financials. The bank will ask for the builder's business financial statements. They want to see their balance sheet, their income statement, their cash flow. They are looking for one thing above all else: stability. Is this a healthy, functioning business? Or is it a house of cards about to collapse? They want to know if your builder is robbing Peter to pay Paul, using the deposit from your project to finish someone else's, all while hoping a new client comes along to fund the start of yours. A builder who is financially overextended is a builder who is one delayed material shipment away from going bankrupt and leaving you with a half-built shell and a mountain of liens from unpaid subcontractors. Next, they'll scrutinize the builder's track record. They'll want a list of recently completed projects, specifically projects that are similar in size, style, and price point to yours. It's great if your builder has built 50 starter homes, but if you're building a complex, custom multi-million-dollar home, the bank needs to see proof they have the experience to handle it. They'll even ask for addresses, sometimes driving by the properties to see the quality of the work for themselves. And then come the references. The bank doesn't just want a list of happy clients. They will call them. They'll also ask for a list of their primary suppliers, the lumber yard, the concrete company, the window manufacturer. The bank's underwriters will call them too. They'll ask pointed questions. Does this builder pay their bills on time? Have you ever had to place a lien on one of their projects? A builder with a reputation for slow paying their suppliers is a massive risk. It signals cash flow problems and is the #1 precursor to subcontractors walking off the job and slapping your future home with a mechanic's lien, which can halt construction for months and create a legal nightmare. Once the bank is satisfied with the who, the builder, they turn their laser focus to the what, the blueprints and the budget. Your beautiful architect-drawn plans are not just a guide for the builder. They are a legal document for the bank. The bank's underwriters, and often a third-party plan reviewer, will comb through every page. They're checking for completeness. Are there structural engineering plans? Are the dimensions and specifications clear? Do the plans comply with local zoning and building codes? An incomplete or poorly designed set of plans is a recipe for delays, cost overruns, and failed inspections, all of which threaten the bank's investment. Simultaneously, they dissect the budget. This isn't a one-page summary. This is a document often called a sworn construction statement or a detailed cost breakdown. It is a multi-page line-item by line-item list of every single conceivable cost to build your home, from the survey and permit fees, all the way down to the doorknobs and light fixtures. Each line has a cost associated with it. The bank scrutinizes this with incredible intensity. They have a deep well of data on construction costs in your area. They know what a foundation should cost per square foot. They know the going rate for framing labor. They know what a reasonable allowance for kitchen cabinets is. If your builder's numbers are way too high, it's a red flag for price gouging. If the numbers are way too low, it's an even bigger red flag. A builder who dramatically underbids the project is either inexperienced, incompetent, or desperate. They're creating an unrealistic budget that is guaranteed to fail, which will inevitably lead to them coming back to you in the bank, hat in hand, asking for more money mid-project. The bank hates, absolutely hates, surprises like that. They will also look for what's missing. Did the builder forget to budget for landscaping? For temporary utilities? For the final cleanup? These omissions can add up to tens of thousands of dollars, and the bank wants every cost accounted for before a single dollar is disbursed. This entire package, your finances, the builder's credentials, the plans, and the budget, is then bundled together for the final and arguably most terrifying hurdle of the approval process: the appraisal. Unlike a regular home loan, where an appraiser looks at a finished house, a construction loan requires a very special kind of appraisal. The bank hires an appraiser who specializes in new construction. They hand this appraiser the complete set of blueprints and the detailed list of specifications. The appraiser's job is to determine the future value of the house, as if it were already built. They will analyze the location, the size of the home, the quality of the finishes you've chosen, the layout, and the overall design. Then they will find comparable, recently sold new construction homes in the area to justify their final number. This appraisal is the linchpin of the entire deal. It is the bank's ultimate safety net, because the bank will only lend you a percentage, typically 80 to 90%, of the lesser of two numbers: the total cost to build your house, or its final appraised value. Let's say your land, plus the total construction contract, adds up to a total project cost of $1 million. You've been approved, your builder has been approved, everything seems perfect. The appraiser goes out, does their analysis, and comes back with a report. You open it, your heart pounding, and you see the number. $1 million. Or maybe 1.1 million. You breathe a huge sigh of relief. The project is a go. But what if the number isn't what you expect? What if, for whatever reason, a cooling market, a lack of good comparable sales, or an appraiser who thinks your design is too unique, the appraisal comes in at only $900,000? This is the moment where countless dream home projects die. The bank doesn't care that your contract says it costs $1 million to build. They will only base their loan on the appraised value of $900,000. So, if they're lending you 80%, their maximum loan is now 80% of $900K, not 80% of $1 million. That $100,000 gap? That's your problem now. You have to come up with that extra cash out of pocket, on top of your original down payment. If you can't, the loan is denied. The deal is dead. And all that time, effort, and money you spent on architects and engineers is gone. The bank will not budge because they will never, ever put themselves in a position where they are lending more money than an asset is worth. This appraisal gap is the silent killer of custom home builds. And it's a terrifying possibility you have to be prepared for long before you ever see that final number. So how do you prepare for this gap? How do you build a bridge over a chasm you can't even see yet? It starts by understanding exactly what the bank is looking at. When the appraiser shows up, they aren't there to admire your vision. They aren't moved by the story of how you always wanted a reading nook with a bay window overlooking the garden. They are cold, hard, data-driven analysts. They have one question to answer. If you defaulted on this loan tomorrow, and the bank had to foreclose and sell this half-finished or newly finished house, how much could they get for it on the open market right now? That's it. That's the entire game. Your cost to build is irrelevant to them. The emotional value is irrelevant. It's all about the as-completed market value. The appraisal gap happens when your total project cost, the land, the plans, the labor, the materials, is higher than that final appraised market value. Let's say your all-in cost to build is $1 million. You're thrilled. You've got your loan pre-approval for 80% of the cost, so you're expecting to get a loan for $800,000. But then the appraiser comes back and says, based on the comparable sales in this area and the features of this home, I appraise its future value at only $900,000. Suddenly, the bank's calculation changes. They are no longer lending you 80% of your $1 million cost. They are lending you 80% of the $900,000 value. That's $720,000. Your expected $800,000 loan just became a $720,000 loan. You are now short $80,000. And that money isn't just an oops. That is $80,000 in cash you have to come up with right now to close the loan and even begin construction. For most people, that's a knockout blow. The project is dead before the first shovel ever hits the dirt. So what causes this? Why would a house cost more to build than it's worth? The number one reason is over-customization. You see, the things that make a house a home to you often make it a bizarre, niche product to the open market. That professional-grade recording studio you built in the basement? To an appraiser, that's not a $50,000 asset. It's a liability. It's weird. It's a huge chunk of square footage that a normal family can't use. They'd have to spend money to rip it out. The value might actually go down. That incredibly expensive, hand-laid mosaic tile you imported from Morocco for the master bathroom? To you, it's a priceless piece of art. To an appraiser, it's just tile. It gets you no more value than a nice, clean, modern tile from a big box store. The market rewards what is popular, what is standard, and what is broadly appealing. The more you deviate from that, the higher the risk of an appraisal gap. The second major cause is a lack of good comps. Appraisers build their valuation by looking at comparable, recently sold properties in your immediate area. But if you're building a 4,000 square foot modern farmhouse in a neighborhood of 2,000 square foot, 50-year-old ranch homes, what can they possibly compare it to? There are no comps. They have to guess. And when an appraiser has to guess, they always guess low. They are conservative by nature because they work for the bank. And the bank's primary goal is to avoid risk. Building the biggest, best house on the block sounds like a great idea, but it's one of the fastest ways to get crushed by a low appraisal. So knowing this, how do you defend yourself? You have to go on the offensive and you have to start early. Your first line of defense is your builder and your realtor. A good, experienced local builder will have a gut feeling for this. They'll be able to tell you, hey, putting a 6-car garage on this house is going to cost you $150,000, but I guarantee you it won't add more than $50,000 to the appraised value. Are you sure you want to do that? They act as your reality check. guiding your design choices toward things that add provable value, not just personal satisfaction. Your second and most powerful weapon is the appraisal package. You cannot just sit back and hope the appraiser figures it out. You or your builder need to hand-deliver them a comprehensive package of information that makes a powerful case for your value. This package should include the full architectural plans, a highly detailed list of every single finish and fixture, the brand of the appliances, the type of countertops, the model of the windows. It should also include a copy of your signed construction contract and a detailed cost breakdown. You're showing them line by line that this is a high-quality, expensive build. But the most critical piece of this package is a list of suggested comparable properties. You and your realtor need to do the appraiser's homework for them. Find the 3 to 5 best comps, even if they're a little further away or require some digging to find. Justify why they are good comps. Maybe one has a similar quality of finish, another has a similar square footage, and a third is on a similar lot. You are building the argument for them. You're controlling the narrative. An appraiser who receives a well-organized, comprehensive package is far more likely to see things your way than one who just shows up to a muddy lot with a set of plans they can't make sense of. Even with all that, you still need a safety net. This is your third line of defense, a dedicated cash contingency specifically for an appraisal gap. This is not the same as your 10 or 15% construction contingency for material overages or change orders. This is a separate sacred pile of cash that you hope you never have to touch. How much? Depends on your risk. If you're building a fairly standard home in a subdivision with lots of great comps, maybe 3 to 5% of the build cost is enough. If you're building a highly custom, unique home on a strange lot, you better be prepared with 10, maybe even 15% of the build cost in liquid cash, ready to deploy to bridge that gap. If you don't have it, you are gambling with the entire project. But what if you do everything right and the appraisal still comes in low? You're not out of options. You can challenge it. This is called a reconsideration of value. You can't just complain that you don't like the number. You have to find factual errors in the report. Did they list the house as having 4 bedrooms when it has 5? Did they get the square footage wrong? Did they use comps from a clearly inferior neighborhood across the highway? If you can find legitimate errors, you can submit a formal rebuttal with supporting evidence. Sometimes this can get them to adjust the value upward. And if that fails, you have one last resort. Get a second opinion. You can ask the lender if they're willing to order a new appraisal from a different company. You'll have to pay for it, of course, and there's absolutely no guarantee it will come in any higher. It's a roll of the dice. But if you're facing a project-killing shortfall, another $500 or $600 for a second chance might be worth the gamble. The appraisal is the single greatest hurdle in the entire construction loan process. It's where the subjective world of your dreams collides with the objective reality of the market. But it is not an insurmountable obstacle. It's a strategic challenge that you can win with the right team, the right preparation, and the right financial buffer. By treating the appraisal not as a formality, but as a critical battle to be won, you protect your investment and ensure your dream home actually has a chance to become a reality. Now let's assume you've done it. You navigated the application, you survived the underwriting, and you conquered the appraisal. The bank has approved your loan. The money is there. But here's the thing, it's not your money. Not yet. The bank doesn't just wire you $800,000 and wish you luck. They hold on to that money with an iron grip, and they only release it piece by piece as the work is actually completed. This is the draw process, and it is the beating heart of the construction phase. Understanding how it works is the difference between a smooth, efficient build and a project mired in delays, angry contractors, and non-stop financial stress. So let's paint a picture of that stress. It's a Tuesday morning. You get a call from a number you don't recognize. It's the head of the framing crew. He's polite but firm. He says his guys haven't been paid for the last 2 weeks of work, and if the money isn't wired by Friday, they're pulling off your job to go to another one that pays on time. Your heart sinks. You paid the builder. Where did the money go? This exact scenario is what the draw process is designed to prevent. It's not just a system for paying bills. It's a system of accountability. It's a series of checks and balances that ensures the right people get paid the right amount of money at the right time. The entire process is built around a document called the draw schedule. This isn't some casual agreement. It's a detailed, legally binding part of your loan agreement that you, your builder, and your lender all sign off on before a single shovel of dirt is moved. Think of it as the financial roadmap for your entire build. It breaks the project down into distinct phases, usually between 5 and 10 of them, and assigns a specific dollar amount to each one. For example, draw number 1 might be for site work, foundation, and slab, and it might be worth $50,000. Draw number 2 could be for framing and roofing, worth $80,000. Draw 3 for rough and plumbing, electrical, and HVAC, and so on all the way through to the final draw for finishes, landscaping, and final cleanup. The key principle is simple but non-negotiable. The bank will not release the money for a phase until the work in that phase is verified as complete. The money follows the work, never the other way around. This prevents a builder from getting paid for a roof that hasn't been installed yet, and then disappearing. So, how does it actually happen? Let's walk through the life cycle of a single draw. Let's use draw number 2, framing and roofing. The last of the shingles are on, the house is fully framed, and the windows have been installed. Your builder is now ready to get paid for that $80,000 phase of work. Step 1. The builder submits a draw request. The builder can't just call the bank and ask for cash. They have to submit a formal package of paperwork. This usually includes a signed form requesting the specific draw amount, lien waivers from all the subcontractors and suppliers who worked on that phase, like the framers, the roofers, and the window company, and often photographic evidence of the completed work. Those lien waivers are critically important. A lien is a legal claim against your property. A signed waiver is a subcontractor's legal promise that they have been paid in full for their work, and they forfeit their right to place a lien on your home. This protects you from a terrible situation where you pay your builder, but the builder doesn't pay his subs, and now those subs can legally come after your property for payment. Step 2. The bank orders an inspection. Once the bank receives the draw request, they don't just take the builder's word for it. They are, after all, on the hook for hundreds of thousands of dollars. They dispatch an independent, third-party inspector to your job site. This inspector is not a home inspector looking for cosmetic flaws. Their job is singular: to verify that the work claimed on the draw request has been completed according to the agreed-upon plans and schedule. They have a copy of the draw schedule, and they literally walk the property with a checklist. Is the framing 100% complete? Yes. Is the sheathing on? Yes. Are the windows and doors installed? Yes. Is the roof complete? Yes. They will then compile a report, complete with photos, and send it back to the lender, certifying that the work is, for example, 100% complete for that particular draw. Now, what if it's not? What if the inspector finds that the roof is only halfway done? They'll report that back to the bank. The bank will then only approve a partial payment, say 50% of the draw amount, until the rest of the work is finished. This is the bank's primary tool for managing its risk. Step 3. You approve the draw. This is where you come in, and this is a step many homeowners don't realize they have power in. The lender, after receiving the inspector's report, will almost always require your signature before releasing the funds. They will send you the inspector's report and the builder's request. This is your chance to be the final gatekeeper. Your signature is power. It is your confirmation that you agree with the inspector, and you authorize the bank to pay your builder. Do not take this step lightly. Before you sign anything, you should physically go to the site and see the progress with your own 2 eyes. Does it match what the report says? Are you satisfied with the quality of the work that has been done? If you see something that isn't right, or work that's incomplete, now is the time to speak up. Do not sign that approval form until your concerns are addressed. Once you sign, the money is gone, and so is your leverage for that phase of work. Step 4. The bank releases the funds. After the bank has the builder's request, the inspector's report, and your signed approval, they will finally release the money. How this happens can vary. Sometimes the money is wired directly into the builder's bank account. In other cases, it's deposited into a joint account that requires both you and the builder to sign a check. And in some cases, the bank might issue 2-party checks made out to both the builder and the specific supplier or subcontractor. This is another layer of protection to ensure the lumber yard or the plumbing company gets paid directly. The whole cycle, from the builder's request to the money being in their account, typically takes about 3 to 7 business days, assuming there are no problems. And then the process repeats itself for the next draw. The builder moves on to the rough and plumbing and electrical, completes the work, submits a request for draw number 3, the inspector comes out, you approve it, the bank pays, and on it goes. It's a rhythm, a predictable, bureaucratic, but incredibly important dance of work, verification, approval, and payment. One common point of confusion is materials. What if your builder buys all the drywall for the whole house and has it stacked in the garage, but hasn't installed it yet? Can they get paid for it? The answer is usually no, but sometimes yes. Most lenders will only pay for work that is completed and attached to the property. A stack of drywall is just a stack of materials. It's not a finished wall. However, some lenders may allow for a materials draw if the materials are securely stored on site, are properly insured, and the builder can provide receipts. This is something you need to clarify with your specific lender upfront. The entire system is designed to keep the project moving forward smoothly while protecting everyone involved. It protects you from paying for work that isn't done. It protects the bank from lending money on a project that's falling behind schedule. And it protects the good, honest builders by giving them a reliable and predictable cash flow to pay their crews and suppliers on time, avoiding that dreaded phone call about a crew walking off the job. This methodical process works beautifully in a perfect world. But home construction is rarely a perfect world. What happens when you, the homeowner, decide you want to move a wall or upgrade from carpet to hardwood floors in the bedrooms after the budget is already set? That's when you introduce a powerful and potentially dangerous variable into this carefully calibrated equation: the change order. And how you handle change orders can be the difference between staying on budget or seeing your costs spiral completely out of control. So let's talk about the change order. On paper, it sounds simple. It's a formal document that amends the original construction contract. You want to change something, you and the builder sign a piece of paper and it happens. But in reality, a change order is like a small controlled explosion in the middle of your finely tuned project plan. And it creates shrapnel that hits 3 critical areas: your budget, your timeline, and your relationship with the bank. Let's start with the most obvious one, the cost. When you decide midstream that you want to move a wall 6 inches to the left, you're not just paying for the new work. You're paying for the demolition of the old work. You're paying for the time the framers spend undoing what they just did. If electrical or plumbing was already run in that wall, you're paying for the electrician and the plumber to come back for an unscheduled visit, which is always more expensive. Then you're paying for the new materials, the new labor, and on top of all of that, the builder is going to add their administrative fee and markup, which is typically anywhere from 15 to 25%. Suddenly, a seemingly simple change like adding 2 extra recessed lights in the living room isn't just the $100 for the fixtures. It's the electrician's return trip fee, it's the cost of patching and repainting the drywall, and it's the builder's percentage on top of the whole thing. A $100 idea can easily become a $1,000 change order. Now multiply that by 5 or 10 small ideas over the course of a build, and you can see how a budget gets absolutely shredded. This is death by 1,000 cuts. The second piece of shrapnel is the timeline. A construction schedule is a complex domino rally. The framers have to finish before the plumbers and electricians can do their rough-in. They have to finish before the drywall can go up. The drywall has to be finished, taped, and mudded before the painters can start. The painters have to finish before the flooring can go in. It's an intricate dance. When you issue a change order, you throw a wrench into that dance. Let's say you decide you want a different, custom order tile for the master bathroom. The tile you originally chose was in stock and ready to go. This new tile has a 6-week lead time. The entire project doesn't just pause and wait. Your builder might move crews to another job. The tiler, who was scheduled for your project this week, now has to go work on 3 other houses. Getting him back on your schedule when the tile finally arrives isn't guaranteed. That 6-week tile delay can easily cause a 10-week delay to your final move-in date, because you've lost your spot in line with multiple subcontractors. And while all this is happening, what are you still paying? The interest on your construction loan. The longer the build takes, the more interest you pay. But the third and most critical impact, the one that ties directly back to your construction loan, is how the bank views this. The lender approved your loan based on a very specific set of documents: the architectural plans, the specifications, and the fixed price contract with your builder. That package represented a specific risk and a specific appraised value. A change order alters that fundamental agreement. So how does this work mechanically with the lender? It depends on the nature of the change. Let's say you make a small cosmetic change. You upgrade your kitchen countertops from the planned quartz to a more expensive marble. This adds $5,000 to the cost. In almost every case, the bank is not going to increase your loan amount for this. They will expect you to pay that $5,000 directly to the builder, out of your own pocket, immediately. This is where your personal contingency fund gets hit. The builder won't proceed with the change until they have your check, because they're not going to finance your upgrade. Now, what if it's a major change? What if you decide to finish the basement, which wasn't in the original plan, adding $40,000 to the cost but also theoretically adding value to the home? This is a much bigger deal for the bank. You can't just pay this out of pocket. You have to formally request a modification to your construction loan. The lender will require a new cost breakdown from the builder for the change. They will then send that information back to the original appraiser to get an updated, as-completed value. The appraiser has to agree that finishing the basement adds at least $40,000 in value to the home. If they do, and if your financial situation still supports a larger loan, the bank might approve the increase. This process is not fast. It can take weeks, halting progress on that part of the house and causing major delays. And there is absolutely no guarantee of approval. If the appraiser says the change doesn't add enough value, or if the bank is just not comfortable with the modification, they will deny it. Then you're left with a choice. Abandon the idea, or find a way to pay for a $40,000 change with cash you might not have. This is why the most successful building projects are run with a zero change order mindset. The battle for your budget is won or lost long before the first shovel hits the dirt. It's won in the planning phase. It's won by spending months, not weeks, poring over your blueprints. It's won by using 3D modeling software to virtually walk through your house, to feel the size of the rooms, to check the placement of windows. It's won by going to appliance stores and showrooms and picking out every single finish, every faucet, every light fixture, every doorknob, and having it all documented in your contract before you sign. You have to be ruthless with yourself. Because once construction starts, you will be tempted. You'll stand in the framed-up kitchen and think, you know, an extra window over the sink would be perfect. That is the most expensive time to have a good idea. That idea, which would have cost maybe $1,000 during the design phase, is now a $5,000 change order that delays the project by 3 weeks. You must differentiate between the two types of change orders, the wants and the needs. The wants are the ideas that pop into your head as you see the project come to life. These are the ones you must learn to say no to. The needs are the unavoidable, unforeseen issues. The excavator hits a massive underground boulder that has to be dynamited. The soil test comes back with unexpected results requiring different, more expensive foundations. This is what your contingency fund is truly for. It's a safety net for the genuine unknowns, not a slush fund for mid-project upgrades. Your contract with the builder should have a crystal clear section on how change orders are handled. It should specify the builder's markup percentage, the exact process for submitting and approving a change, and the payment terms. Never ever agree to a change based on a verbal conversation. Every single alteration, no matter how small, must be documented in a formal change order, signed by both you and the builder, with the cost and time implications clearly spelled out. This isn't about mistrust, it's about clarity. It protects you and it protects the builder, and it creates a paper trail that your lender will absolutely require. So you've navigated this minefield, you've guarded your budget with your life, and construction is chugging along. The foundation is poured, the walls are up, the roof is on. Your builder submits their first big invoice, the first draw request, to the bank. But the bank isn't just going to take their word for it and cut a check for $100,000. They need proof. They need to verify that the work you're paying for has actually been completed to a certain standard. To do that, they send out their own representative, a crucial player whose opinion can make or break your timeline, the inspector. And what that inspector finds or doesn't find in their brief walkthrough determines whether the money keeps flowing, or if your entire project grinds to a sudden, frustrating halt. This inspector, often a third-party professional hired by the bank, becomes the most important person on your job site for about 30 minutes every month. They hold the keys to the kingdom. They are the bank's eyes and ears, sent to verify one simple brutal truth. Is the work that the builder is asking to be paid for actually complete? They aren't there to check for code compliance in the way a city inspector is. They don't care if the electrical outlets are precisely 6 feet apart. They are there to perform a kind of financial audit with a tape measure and a camera. Imagine this. Your builder submits a draw request to the bank. This is the official invoice. It says, "We've completed the foundation, the framing, and the rough-in plumbing. According to our agreed-upon schedule, that's worth $200,000. Please release the funds." The bank doesn't just take the builder's word for it. They dispatch the inspector. This person shows up at your muddy, chaotic construction site with a clipboard and one mission: to walk through the property and visually confirm that the work claimed on that draw request matches the reality on the ground. They're looking at percentages. Is the foundation 100% complete? Yes. Check. Is the framing 100% complete? Well, they see the walls are up, but the roof sheathing is only halfway done. In their eyes, that's not 100%. Maybe it's 85%. Is the rough-in plumbing done? They see pipes in the walls, but the main sewer line isn't connected yet. So no, that's maybe 70% complete. The inspector takes their notes, snaps a few photos for proof, and sends a report back to the bank. And this is where your dream project can turn into a financial nightmare. The bank looks at the report and says, okay, the builder asked for $200,000, but our inspector says only $160,000 worth of work is actually complete. So they only release $160,000. Now, you have a $40,000 problem. Your builder was counting on that full $200,000. He has to pay the framer who has a crew to pay. He has to pay the plumber who has to pay his supply house. He has to pay for the next delivery of windows that are sitting on a truck. But he's short. The framer gets angry because he's not paid in full. The plumber threatens to walk off the job. The window delivery gets postponed. And you, the homeowner, are stuck in the middle, watching your timeline evaporate because of a discrepancy in percentage points. The entire project grinds to a halt, not because of a mistake or a bad design, but because of cash flow. The money faucet has been turned down to a trickle, all based on one person's 30-minute walkthrough. This is the central tension of the construction draw process. It's a constant battle between the builder's need for cash to keep moving and the bank's need to protect its investment by not paying for work that isn't finished. And it gets even more complicated. Let's talk about one of the most common and frustrating points of failure: stored materials. Picture a massive stack of drywall sitting in what will one day be your garage. Or maybe it's a pallet of expensive Italian tile for the master bathroom. Your builder had to order it months in advance. It's been paid for, and it's sitting right there on your property. The builder, quite reasonably, wants to be reimbursed for it in the next draw. He'll list drywall materials on the draw request for, say, $15,000. The inspector shows up, sees the stack of drywall, and in his report to the bank, he values it at zero. Nothing. The bank will not pay a single dime for it. Why? Because from the bank's perspective, a stack of drywall isn't part of a house. It's just a stack of drywall. It could be damaged by rain, could be stolen. The builder could, in a worst-case scenario, load it onto a truck and take it to another job site. The bank's money is only secured by the physical house itself, the real property. They will only pay for materials that have been permanently installed. That drywall has zero value to the bank until it's screwed to the studs, taped, and mud. This stored materials clause trips up countless projects. A good builder knows this and plans their cash flow accordingly. An inexperienced builder, or one who is financially stretched, can be completely derailed by it. They might have spent $50,000 on materials that are sitting on site, expecting to be reimbursed, only to be told by the bank that they won't see that money for another month or two, until everything is installed. This is how contractors go out of business mid-project. So, how do you protect yourself? You have to understand this process better than your builder. Before you even sign the loan, you need to see the draw schedule that the builder and bank have agreed upon. This document, also called a schedule of values, breaks the entire project down into line items and assigns a dollar value to each. Foundation, $50,000. Framing, $70,000. Roofing, $20,000. And so on. You need to review this with a fine-tooth comb. Does it seem logical? Are the values allocated reasonably? If you see a huge amount of money front-loaded for mobilization or planning, that's a red flag. It could mean the builder is trying to pull cash out of your project early. During the build, you need to stay ahead of the draw requests. When your builder says they're submitting a draw, ask to see a copy. Walk the site yourself. Does it look like the work they're claiming is actually done? You don't have to be an expert, but you can tell if the roof is on or not. If you see a discrepancy, speak up immediately. It's much easier to have a conversation with your builder before the inspector shows up than it is to try and reverse the bank's decision after the fact. Now let's add another layer of complexity. Remember the two types of inspectors? We've been talking about the bank's inspector, who cares about completion percentage. But then you have the city or county building inspector who cares about code. These two worlds are separate, but they can collide with devastating consequences. Let's say your builder finishes the electrical rough-in. The bank's inspector comes, sees all the wires in the walls and signs off. The bank releases the funds for the electrical work. Everyone is happy. But then, the next day, the city inspector comes to do his official code inspection before the drywall goes up. He finds a problem. Maybe the wiring is too close to a water pipe, or the wrong type of breaker was used. He fails the inspection and slaps a big, ugly red tag on the job site. That red tag is a legally binding stop work order for that part of the project. You cannot hang drywall until that electrical issue is fixed and re-inspected by the city. But it gets worse. When the bank's inspector comes for the next draw, the one for the drywall, he's going to see that red tag, and he's going to note it in his report. The bank will see that red tag, and a giant alarm bell goes off in their underwriting department. A red tag means the project is not in compliance, that it has a potential legal or safety issue. The bank will often freeze all future funding until that red tag is cleared. Suddenly, your simple electrical mistake has cascaded into a full-blown crisis. The drywall crew can't work. The painters who were scheduled after them are delayed. And the bank has turned off the money. The builder can't get the funds to fix the original problem or pay for the other trades. This is how projects stall for weeks, or even months, burning through your contingency fund and causing immense stress, all because one inspection failed. The entire draw process is a monthly dance on a tightrope. It requires constant communication between you, the builder, and the bank's loan officer. When it works well, it's a seamless flow of capital that keeps the project moving like a well-oiled machine. But when it breaks down, the machine seizes up. The key is to be proactive, not reactive. Understand the schedule, anticipate the inspections, and communicate relentlessly. As you navigate these monthly hurdles draw by draw, your house slowly takes shape. The foundation gives way to a skeleton of wood, which is then wrapped and roofed, then filled with a nervous system of wires and pipes. Finally, the drywall goes up, and for the first time it starts to feel less like a construction site and more like a home. You are nearing the finish line. But the final draw, the one that gets you from almost done to move-in ready, is the most complicated of all. It comes with a whole new set of rules and a mountain of paperwork designed to protect the bank from one final catastrophic risk. Getting that last check, the one that finally pays your builder in full, requires clearing a series of final hurdles, starting with a little piece of paper called a certificate of occupancy. A certificate of occupancy, or a C of O, isn't just a bureaucratic formality. It's the official declaration from your local government, your city or county, that your house is no longer a dangerous, active construction site. It is a safe, habitable dwelling fit for human life. It's the birth certificate for your home. Without it, you legally cannot live there. More importantly, without it, the bank will not release that final massive chunk of cash to your builder. Getting this certificate means you have successfully run the gauntlet of final inspections. This isn't just one inspector showing up with a clipboard. It's a series of them. The electrical inspector comes to ensure every outlet is wired correctly, that the breaker box is up to code, and that you won't have a fire the first time you plug in a toaster. The plumbing inspector will flush every toilet and run every faucet, checking for leaks, proper drainage, and water pressure, ensuring your home's circulatory system is sound. The HVAC inspector will fire up the furnace and the air conditioning, making sure the ductwork is sealed and the system can actually heat and cool the space it was designed for. And finally, the general building inspector will do a holistic review, checking everything from staircase handrails and window egress to smoke detector placement and insulation. Each one of these inspectors has the power to hit the brakes on your entire project. If they find a violation, they issue a red tag, and all work must stop until the issue is fixed and they come back for a re-inspection. It's a nerve-wracking process where your dream home is judged by a series of experts whose only job is to find flaws. But once you've collected all their green tags, once every box is checked, the city grants you that golden ticket, the certificate of occupancy. You might think that's the final hurdle. You have the government's blessing. But you've forgotten about the entity with the money, the bank. The bank now sends out its own final inspector. This person isn't concerned with building codes. They couldn't care less about the gauge of your wiring or the slope of your drain pipes. Their job is to answer one single question for the bank. Is the house we paid for actually built? They walk through the property with a copy of the original plans, the appraisal, and the sworn construction statement. They are comparing the finished product to the promised product. Are the granite countertops that were in the budget actually installed? Or did the builder swap them for cheap laminate? Is the high-end appliance package you paid for sitting in the kitchen? Or is there a set of budget models in their place? Does the square footage match the plans? Is the landscaping done? They are protecting the bank's collateral. They need to ensure that if you defaulted on the loan the very next day, the bank could sell a complete, finished home, not a 95% finished project that's worth significantly less. This inspection is the bank's final, self-interested reality check. Once the bank's inspector gives their approval, and you've submitted the certificate of occupancy, the bank prepares the final draw. But even now, they don't just hand over the remaining balance. They hold back a portion, typically around 10%, in what's called retainage. This is the bank's and your ultimate piece of leverage. This retainage is tied to the successful completion of one last, often agonizing task: the punch list. The punch list is a detailed catalog of every minor flaw, every scratch, every drip, every single thing that isn't perfect. You, your builder, and sometimes your real estate agent will walk through every square inch of the house with a roll of blue painter's tape and a notepad. A paint scuff on the wall? Tape it. A cabinet door that doesn't close quite right? Tape it. A tiny crack in a tile's grout? Tape it. A nail pop in the drywall? Tape it. This is your last chance to get the builder to fix all the small, annoying imperfections on their dime. It can be a contentious process, but it's critical. The builder wants that final 10%. You want the perfect house you paid for. The retainage ensures you have the power to demand that perfection. Only when you sign off on the completed punch list, confirming every last item has been addressed, will the bank release the retainage and pay the builder in full. But we're still not done. There's one more ghost in the machine. One final threat that can emerge from the shadows long after your builder has cashed his check and disappeared. It's called a mechanic's lien. Imagine this nightmare scenario. You've been living in your home for 3 months. Everything is perfect. Then you get a certified letter. It's from the lumber company that supplied the wood for your framing. They claim your builder never paid them their final $20,000 invoice. And because their materials were used to improve your property, they are placing a lien on your house. This means they now have a legal claim against your home. If they aren't paid, they can, in a worst-case scenario, force the sale of your house to get their money. And it's not just the lumber company. It could be the drywall contractor, the electrician, the plumber, or any subcontractor or major supplier who worked on your home. This is the single biggest post-construction risk you face. To prevent this catastrophe, the bank requires one final set of documents before releasing that last payment. Final, unconditional lien waivers. A lien waiver is a legal document signed by a subcontractor or supplier, stating that they have been paid in full for their work, and that they waive any future right to place a lien on your property. The key words here are final and unconditional. Throughout the project, your builder was likely collecting conditional lien waivers with each draw, which basically said, "I will waive my lien rights on the condition that this check you're giving me clears." But for the final payment, the bank needs unconditional proof. They need ironclad certainty that nobody can come back later with a claim against the house. Your general contractor will have to collect these signed waivers from every single major sub and supplier. It's a mountain of paperwork, a final administrative sprint, but it's arguably the most important paper besides the deed itself. It's a shield that protects you and the bank from hidden debts, ensuring that when your home is finished, it is truly, completely, and undisputedly yours. With the C of O secured, the bank inspection passed, the punch list completed, and a thick folder of lien waivers in hand, the construction phase is officially over. The final draw, including the retainage, is released. Your builder is paid off. The construction loan has served its purpose. Now, it must undergo its final transformation. It needs to morph from a short-term, interest-only, draw-based loan into a long-term principal and interest, fully amortizing permanent mortgage. This is the moment you've been working towards for over a year. This is where you stop paying just interest and start actually building equity. How this happens depends on the type of loan you got in the first place. If you have a one-time close or construction to permanent loan, the process is almost automatic. Your loan simply modifies. The terms you agreed to a year ago, your interest rate, your 30-year term all kick in. There's no new application, no new credit check, no new appraisal. It is a seamless, predetermined conversion. The benefit is the certainty and simplicity. You locked in your rate long ago, protecting you if rates have gone up. The downside is that you're stuck with that rate even if rates have gone down. If you have a two-time closed loan, your construction loan is essentially a standalone product. To pay it off, you must now apply for a brand new separate mortgage just like any other home buyer. This means a full underwriting process. New application, new credit pull, new income verification, and a new appraisal on the now completed home. The advantage here is flexibility. If interest rates have dropped since you started, you can now shop around for the absolute best deal on the market. You aren't tied to the lender who gave you the construction loan. The risk, of course, is that if rates have risen significantly, you could be facing a much higher monthly payment than you originally planned for. It's a gamble, but one that can sometimes pay off. Whichever path you take, the end result is the same. The complex, high-stakes construction loan is gone, and in its place is a simple, predictable, permanent mortgage. The war is over. The house is built. And now you can finally begin the quiet, steady rhythm of just living in your new home. But that quiet rhythm doesn't begin the second the final nail is hammered. The war might be over, but you still have to sign the peace treaty and check for landmines. This final phase, the handoff from construction project to permanent home, is where fortunes are protected and nightmares are prevented. It's the last 1% of the journey, and it's arguably the most important. Your first order of business is the punch list. This is your final walkthrough with the builder, and you need to transform from a weary homeowner into the world's most demanding detective. Armed with the roll of blue painter's tape and a notepad, you will inspect every square inch of your new home. Every paint drip, every misaligned cabinet door, every scratch on the floor, every faucet that doesn't feel quite right. Gets a piece of tape and a note. Be ruthless. Be meticulous. This is not the time to be nice or to feel bad about pointing out flaws. You are not criticizing your builder's character. You are ensuring the contract you both signed has been fulfilled to the letter. That final draw, the last chunk of the bank's money that the builder is desperately waiting for, is your leverage. Do not sign off on that final payment until every single item on your punch list is corrected to your satisfaction. Once that check is cashed, your power to get things fixed evaporates almost instantly. While the builder is fixing those punch list items, you have a critical mission of your own. You need to secure a final unconditional lien waiver from your general contractor, and just as importantly, from every single subcontractor and major material supplier who worked on your house. Let me say that again because this is the single most important thing you will do in this entire final phase. You need a signed lien waiver from the framer, the plumber, the electrician, the roofer, the cabinet maker, the flooring company, the concrete supplier, everyone. What is a lien waiver? It's a legal document that says, I have been paid in full, and I waive my right to place a mechanic's lien on this property. A mechanic's lien is a legal claim against your home. If, for example, your general contractor failed to pay the lumber yard, that lumber yard could legally place a lien on your house, effectively holding your property hostage until they get paid. It wouldn't matter that you paid your general contractor. The debt attaches to the property, to you. Securing these waivers is like collecting shields. Each one you get protects you from a future financial attack. Your title company and lender will likely require the main one from the GC, but you should demand copies from everyone down the chain. Do not accept any excuses. No waivers, no final payment. Period. This is the move that separates a smooth closing from a legal disaster that can haunt you for years. At the same time, the final city or county inspections are happening. The inspector will walk through, checking everything against the building code, from smoke detector placement to staircase railing height. Their final sign-off results in the issuance of the most magical document in this whole process, the Certificate of Occupancy. This piece of paper is the government's official declaration that your house is no longer a construction site, but a safe, legal, and habitable dwelling. It is the finish line. It's what allows you to legally live there, and it's the final trigger for the bank to close out the construction loan and roll it into that permanent mortgage. And then it happens. The chaos stops. The parade of trucks and tradespeople ends. The phone stops ringing with urgent questions about tile grout and light fixtures. One evening, you'll lock the front door, and the only sound will be the hum of the new refrigerator. It's a strange, beautiful silence. You've done it. But the house isn't done with you. For the first year, your home will be a living, breathing thing. It will settle. The lumber that makes up its bones will continue to dry and adjust to the indoor climate. This is perfectly normal. You'll see small cracks in the drywall, usually around corners of doors and windows. You'll hear creaks and groans you don't recognize. You might see a nail pop, where a drywall nail head pushes a tiny circle of paint outward. Don't panic. This is the house settling in for the long haul. Most builders provide a 1-year warranty to come back and fix these cosmetic settling issues. Keep a running list, and around the 11-month mark, submit it to your builder for a single efficient repair visit. So now, standing in your finished living room, looking out the window at the yard you planned, we have to ask the ultimate question. Was it worth it? Was this brutal, expensive, soul-crushing gauntlet of a process worth the prize at the end? Because let's be honest, building a home is one of the most stressful things a person can do. It will test your patience, your budget, and your relationships. There will be days you regret ever starting. You will spend more money than you ever thought possible on things you never knew existed, like flashing tape and P-traps. You will make 1,000 decisions, and you will lie awake at night convinced you made the wrong choice on at least half of them. Buying an existing house is easier. It's faster. It's more predictable. You turn a key and you're home. But you don't get to choose where the windows go. You don't get to design the kitchen around the way your family actually cooks and lives. You don't get to stand on a patch of dirt and say, "This is where we'll watch our kids grow up," and then watch beam by beam as that exact spot takes shape. The true value of a construction loan isn't just the money. It's the access it grants you. It's the key that unlocks the ability to translate a dream from a blueprint into reality. You didn't just buy a house. You willed it into existence. Every outlet, every doorknob, every paint color is a direct result of a choice you made. This place is a physical manifestation of your vision. And financially, if you manage the process well, you've likely walked into your new home with a powerful advantage: built-in equity. Because you took on the risk and managed the project, the finished value of your home is often significantly higher than its total cost. You didn't just build a home. You created an asset from scratch. The journey is a trial by fire. But the reward is a home that is fundamentally, unequivocally yours. A home with no ghosts of past owners, no weird design quirks you have to live with. History starts with you. The first scratch on the floor will be yours. The first holiday meal in the dining room will be yours. The first memories made within these walls will be yours. The construction loan is the complex, intimidating, and powerful tool that makes it all possible. It's a partnership with a bank that bets on your vision. It's a controlled financial waterfall that turns a pile of lumber and a set of plans into the single biggest and most personal investment of your life. It's difficult, yes, but for those who brave the process, it offers the rarest of opportunities. The chance not just to find a place to live, but to build your exact place in the world.